Okay, let's unpack this. Imagine a small tech company you might never have heard of, Asset Entities, ticker ASST, suddenly undergoing this radical, almost unrecognizable transformation. We're talking about completely shedding its skin to become something entirely new, a publicly traded Bitcoin Treasury Company.
Yeah, and this wasn't some gradual shift.
No, it was lightning fast,
Yeah.
fueled by a huge capital injection and driven by this incredibly ambitious, complex, and frankly, risky strategy.
Right. Not just holding Bitcoin, but trying to actively outperform it.
So on this deep dive, we're taking the source material you've shared, those excerpts from the ASST Deep Dive Research Report, May 28, 2025, plus the related news and filings, and we're putting it under the microscope.
Our mission really is to cut through the noise.
Exactly. Figure out what this new ASST is now, break down these intricate strategies, size up the team, peek at the financials, wrestle with the risks.
And figure out what it means if you're trying to get a handle on it, especially, through a value investing lens.
Yeah, this is definitely not your typical company analysis. And stick around, because the conclusion this source material draws on whether this fits traditional investment principles is, well, pretty stark. And remember, as a Stock Analytics AI member, giving us a ticker like this means we prioritize your custom deep dive. You get analysis and earnings insights tailored to the sources you provide. So if you're finding this valuable, hit subscribe so you don't miss future deep dives. All right, where do we even start with the transformation this dramatic? Let's look at Chapter 1 in the source material. What was Asset Entities before all this upheaval?
Okay, so the source lays it out pretty clearly. Before May 2025, Asset Entities, Inc. was a small tech company focused on digital engagement.
Like social media stuff.
Yeah, social media marketing, content, managing online communities, particularly using their AE.360.DDM service for platforms like Discord. They did influencer campaigns, targeted Gen Z, creators, even had a payment platform called Ternary.
So kind of in that creator economy space, but
Yeah.
sounds like they weren't exactly printing money.
Not at all. The source highlights they were small and, frankly, struggling for profitability. Revenues were really modest, $200K to maybe $680K range.
Per quarter or trailing.
The source mentions both, but the point is it was small, and they were consistently losing money. Significant net losses, like $1.62 million just in Q1 2025.
Ouch. And they were having NASDAQ issues too, right?
Right. The source notes challenges meeting the minimum bid price requirement. They did announce regaining compliance just before the merger announcement, which is significant timing.
Okay, so low revenue, losses, NASDAQ issues. But the source mentions they had some cash and low debt. That seems a bit contradictory.
They did, around $4.2 million in cash and only about $430K to $460K in total liabilities early 2025. So they weren't broke, but the business itself wasn't thriving.
Right.
And this is a key takeaway from the source. The main value of the pre-merger Asset Entities seemed to be its NASDAQ listing, essentially a public shell.
Ah, okay, that makes perfect sense given what happened next. It wasn't the business, it's the access, the public market lifting.
Exactly. Which brings us to the Strive merger. How exactly did this work as a reverse merger?
So Strive, the private company, basically bought the public shell.
Pretty much. On May 7th, 2025, ASST announced the merger agreement with private Strive Asset Management. Strive becomes the operating company, but they kept the ASST ticker symbol.
So ASST is the name on the door, but Strive is absolutely driving the car now.
Precisely. Strive is the clear operational and strategic successor. And the ownership structure really shows this. Strive Enterprises shareholders, it's Strive's parent, were set to own about 94.2% of the combined company.
Wow, 94.2%. And that's before dilution from the PIPE financing and Bitcoin exchanges?
Correct. Legacy Asset Entities shareholders, left with about 5.8%.
So if you were an original ASC shareholder, you got massively diluted right out of the gate. This was Strive buying a public listing, plain and simple.
Seems that way. And their goal. Completely different from social media marketing.
Yeah, becoming the first publicly traded asset management Bitcoin Treasury Company. What does that actually mean in practice?
Well, the core model is holding Bitcoin as the primary treasury asset, similar to MicroStrategy, MSTR.
Okay, we know that model.
But here's where the source highlights Strive's unique twist. Their goal isn't just passive holding. They aim to actively manage their treasury to outperform Bitcoin over the long term.
Outperform Bitcoin.
Yeah,
That's
right.
ambitious. How do they even benchmark that? Bitcoin itself is so volatile.
That's the core of their philosophy, according to the source. They use Bitcoin as the hurdle rate for capital deployment. Meaning any investment, any use of capital has to be projected to generate returns higher than simply holding Bitcoin.
Think about that. Not the S&P 500, not WACC. Their benchmark is Bitcoin. That tells you everything about their conviction.
It's a radical departure from traditional corporate finance. And the source is clear. This model really only suits profoundly bullish Bitcoin investors comfortable with extreme volatility and, well, unconventional strategies.
And the source also mentions they plan to take on an advocacy role, promoting this whole idea.
Yes. Leverage their public status. Use the former ASST CEO's community building skills. Advocate for broader corporate adoption of Bitcoin Treasury strategies.
Okay, so that's the fundamental shift, a complete reinvention. Now, Chapter 2, this is where it gets really interesting and complex. Strive's alpha-generating strategies. How are they planning to actually try and beat Bitcoin?
Okay, the source details several distinct, complex approaches. First up is a proposed Section 351 tax-deferred Bitcoin for equity swap.
Section 351, that's part of the U.S. tax code, right? Tax-free transfers of property to a corporation for stock.
Exactly. The idea is accredited investors contribute their Bitcoin directly to AST for company stock, and potentially it's tax-deferred for the investor.
Okay, so if you're sitting on a big Bitcoin gain, you could swap it for AST stock without maybe triggering capital gains tax immediately. And this helps AST get Bitcoin faster.
That's the aim. Accelerate Bitcoin accumulation without needing immediate cash, attract aligned long-term holders, and offer them a tax-efficient way to diversify. They've mentioned a potential $1 billion cap for this.
What's the catch? The source must point out risks here. This sounds complicated legally and tax-wise.
Absolutely. Big risks. Success hinges on meeting strict Section 351 requirements, like the control test contributors, plus original owners needing 80% ownership after.
Okay.
There's also the risk AS gets classified as an investment company under certain rules, which could derail this. It depends heavily on favorable IRS interpretation.
And if the tax treatment gets challenged?
The whole strategy could be undermined. Plus, the source raises fairness questions. Are Bitcoin contributors getting better terms than cash investors in the public market?
That's a fair point. Okay, there's one complex strategy. What else is in the playbook?
They also plan to acquire cash at a discount.
Yeah.
By merging with or acquiring public companies, especially biotechs, that are trading below their net cash value. Companies with stranded capital, as they put it.
So finding a company with, say, $100 million cash, but only a $50 million market cap, buying it and taking the cash.
That's the theoretical idea. Strive sees this as a big opportunity, claims a distinctive competitive advantage here, leveraging the CFO Ben Pham's background. They mention using CVRs in biotech deals, too.
Contingent value rights, like payouts based on future events.
Exactly, to bridge valuation gaps or handle uncertainty.
Buying $1 for 50 cents sounds great, but the source seems skeptical about how easy this is.
Very skeptical, significant execution risk. Companies trading below cash often have deep problems. Cash burn, liabilities, failed drugs. Extracting that cash isn't simple.
Right. There's usually a reason they're cheap.
Precisely. The source questions the distinctive competitive advantage claim as unproven for Strive in the specific game and doubts finding easy pickings. It adds operational complexity big time.
Okay, Section 351, acquiring cash. What's strategy number 3 for Alpha?
Acquiring distressed Bitcoin claims.
Like from bankruptcies and GOCs, things like that.
Exactly. Buy these claims at a discount to the Bitcoin NAV they represent. They plan to partner with a firm called 117 Partners LLC for this. The source estimates the market opportunity here could be over 75,000 Bitcoin.
Wow. That sounds incredibly niche and complicated.
It is. Highly specialized distressed asset play. Returns depend on the discount and the final recovery, which can take years. It's legally complex, uncertain, involves counterparty risk, liquidity risk.
They're not a quick win.
Definitely not. Value realization could take a long time, subject to court outcomes.
And finally, the source mentions using institutional leverage and derivatives, financial engineering.
Yes. Leverage the team's expertise, particularly CEO Matt Cole's background, to enhance Bitcoin accumulation or manage risk. Things like options overlays, prepaid forwards.
Okay, sophisticated stuff.
Yeah.
But the source mentions they framed this as leverage without additional risk. That sounds off.
That's exactly what the source calls out. It's contradictory. Leverage always amplifies gains and losses.
Oh.
While derivatives can hedge, hedges cost money, aren't perfect, and these strategies bring new risks. Counterparty, basis, model risk. If their models are wrong or a counterparty fails.
Big loss is possible, especially with Bitcoin's volatility.
Exactly. Requires exceptional skill, transparency, rigorous risk management, all crucial but unproven for, Strive in this specific context, according to the source.
So this multi-pronged, highly complex approach, tax swaps, distressed M&A, distressed claims, leverage is how they plan to beat Bitcoin. Very different from MicroStrategy, just buying and holding.
Totally different. MSTR is the benchmark. Strive aims to differentiate with active alpha strategies. Others like Trump Media, 21 Capital have Bitcoin too, plus simple Bitcoin ETFs exist for passive exposure.
And Strive's claimed advantages, what do they say sets them apart?
The sourceless, the Section 351 structure, access to a shelf registration for capital raising, these alpha strategies, their team's expertise, and their media stack for communication.
So they're positioning themselves as a more sophisticated, active way to get Bitcoin exposure. But as we've discussed, way more complex and risky than just holding.
Absolutely. That alpha claim is central, but adds huge execution risk.
Let's shift gears. Chapter 3, the management team. Who's running this new Strive entity?
Mostly folks from Strive Asset Management. Matt Cole is CEO and chairman, background in fixed income at CalPERS, longtime Bitcoin guy. Ben Pham is CFO experience in biotech finance at Roy Vaught Citigroup Banking.
Okay.
Arshia Sarkani, the former ASST CEO, is now CMO, leveraging his community skills. Logan Byrne is Chief Legal Officer, M&A background.
What about Vivek Ramaswamy? He co-founded Strive, didn't he? Is he involved day-to-day?
The source points out he resigned as executive chairman of Strive back in Feb 2023 for politics. Not involved in day-to-day management here, though he co-founded the parent, Strive Enterprises.
Got it. And they plan to add independent directors with crypto expertise.
Yes, names mentioned are Ben Workman from Swan Bitcoin, Jeff Walton, who analyzes MSTR, Avik Roy from a think tank, Bitcoin Advocate, adds relevant oversight, which seems important.
How does Strive Asset Management's existing track record fit in? They run ETFs, right?
Right. Founded 2022, grew fast, maybe $2 billion AUM by May 2025, in anti-ESG DEI-themed ETFs. So Cole has a long career, but Strive AM's history is short, and in a different field, thematic ETFs, shareholder advocacy.
So their track record isn't in running a corporate Bitcoin treasury with these complex alpha strategies.
That's the key distinction the source makes. This specific business model, Bitcoin Treasury plus active alpha generation using these methods, is a new and untested venture for the Strive organization. Experienced people, yes, but zero organizational track record in this.
Okay, how does the source evaluate management's alignment with shareholders? Thinking like Buffett is their skin in the game.
It's a mixed picture, according to the source.
What's the positive signal?
Insider ownership and investment. Strive Enterprises owns the vast majority, 94%. And crucially, CEO Matt Cole and other Strive managers personally invested in that big $750 million PIPE financing.
Okay, they put their own money in. That's usually good.
Generally seen as a good sign of conviction, yes.
And the negative side. Dilution seems like a big one.
Huge concern from the start. That reverse merger crushed original AST holders down to 5.8%. The PIPE included warrants more shares later. They have a planned $1 billion shelf registration potential for massive future offerings.
Even if they say raises will be minimally dilutive.
The mechanisms inherently cause dilution. And then there's that PIPE pricing issue.
Right. The PIPE investors paid $1.35 per share, which was way below where the stock traded publicly after the deal was announced, right?
Yeah.
$10, $13 plus ran.
Exactly. A huge gap. This creates unequal entry points. PIPE investors got in much, much cheaper than public buyers right after the news hit.
So questions about equitable treatment?
Definitely. The source highlights that. Plus, the Section 351 exchange is only for select accredited investors, not the general public. So yeah, mixed picture on alignment, invested management, but structural concerns about fairness.
What about corporate governance? Board structure, protecting minority shareholders.
Board chaired by CEO Cole includes other Strive execs. Adding those independent directors is a positive step, but given the complexity, the novelty, and the super concentrated ownership by Strive PIPE investors,
Robust governance is critical.
absolutely essential, the source stresses, for transparency and protecting that small minority of public shareholders. The full details should be in the S-4 filing.
Okay, let's talk money. Chapter 4, the financial landscape. The old ASST numbers. Totally irrelevant now, right?
Completely irrelevant, the source is clear. Modest revenue, big losses, negative cash flow. Tells you nothing about the new company, just why it was a good shell.
So what's the new picture look like, pro forma, after the merger and the PIPE?
Starts with that $750 million cash from the PIPE. That's the key initial asset. designated for buying Bitcoin and funding those alpha strategies.
So the balance sheet totally changes.
Dramatically. Shifts to primarily Bitcoin, plus investments from the alpha place stakes in acquired companies, distressed claims, derivatives, etc.
And revenue, where does that come from now?
Totally different, highly volatile, driven by changes in Bitcoin value and the success or failure of the alpha strategies. No more social media fees.
Does revenue from Strive's existing ETFs flow into AST?
The source says that's unclear from the material provided. Needs clarification. Costs will be public company ops plus significant transaction costs for the strategies.
So how do you even measure performance or value this thing? KPIs must be totally different.
Right. Think total BTC held, BTC per share, net asset value, NAV, and performance versus Bitcoin net alpha. CEO Matt Cole is quoted saying it needs a new valuation framework.
Like valuing a hedge fund or something.
Sort of. Traditional PE, PS are useless. The source mentions possible approaches. NAV calculation is one, but tricky. Comparables like MSTR, but it often trades at a premium. And then trying to value the alpha promise, highly subjective.
Depends on market confidence they can actually deliver.
Exactly. And you have that huge gap between the $1.35 PPE price and the $10, $13 plus public price right after the announcement. Makes any fundamental valuation attempt incredibly difficult.
What about those automated fair value estimates you see online?
The source flags those as completely misleading. Cites one example of 33.2 cents based on old data, irrelevant models. Valuation here is driven by Bitcoin price, hype, sentiment, perceived alpha success. No margin of safety.
So what does the source estimate for the share price range in the immediate future for the rest of May 2025?
The source gives an estimated range of $7.50 to $14 for the remainder of May 2025.
That's a pretty wide range. Needs a big warning label, I assume.
A very strong caveat, yes. The source stresses this reflects extreme volatility, daily swings of 10-20% plus were common, and the highly speculative nature. It's framed as a high-velocity trading vehicle price range, not a value-based target. It could easily trade outside this.
Understood. Let's move to Chapter 5, Market Sentiment. How's the market actually reacting? Any analyst coverage?
Basically none. Formal institutional coverage is non-existent for this newly transformed entity, which isn't too surprising.
So commentary is scattered. Coming from where?
Various platforms, technical analysis sites, news aggregators, maybe some misleading automated ratings like that strong buy, lead Rs, and 32FV example. Timothy Sykes mentioned focusing on volatility for traders. Cantor Fitzgerald acted as an agent advisor, but that's not independent research.
So finding independent, in-depth, fundamental analysis is tough for investors.
Very tough, according to the source. This information gap increases risk. People rely on limited data, narrative.
What about short interest? Are people betting against AST?
Yes, noticeable short interest highlighted in the source. Around 10% of the float reported short by Fintel in late May. But what's really striking are the borrow fees.
How high?
Extremely high, 89% to 139% plus annualized cost to borrow shares to short. Astronomical.
Wow. That signals either huge demand to short or very limited supply of shares to borrow, or both.
Exactly. Combined with high short volume ratios from FINRA data recently, it suggests significant skepticism about the price surge or the model.
And it creates potential for
Short squeezes. Adds another layer of volatility.
any visibility into options trading.
Source notes public options chain data wasn't available in late May. Limits insight there.
How's the general media and investor community talking about it? What's the narrative?
Heavily focused on the merger, the big pay PE deal, and Strive's ambitious Bitcoin alpha strategy. Strive itself seems active in shaping this, using their media megaphone and CMO's skills.
And the initial reaction?
High excitement optimism. Seen in the stock surge, the PE premium over the old price. Seems driven by Bitcoin hype and the novelty, less by deep analysis. But the source cautions this sentiment is fragile, can shift fast.
Okay, Chapter 6, Ownership Structure. Who actually holds the cards now?
Pre-merger, it was diffuse, low insider, tiny institutional ownership. Now, highly concentrated. Strive Enterprises holds that 94.2% pre-dilution majority. Legacy ASST shareholders are that tiny 5.8% slice.
And the big new players are the PIPE investors.
Exactly. That $750 million PIPE brought in a major new block institutions and, importantly, Strive management themselves. Plus, you have future warrant holders, potential Section 351 participants. Control clearly rests with Strive and the PI/PE group.
And we keep coming back to management buying into the PI/PE as a positive signal.
Yes, the source flags that again. CEO Cole, others putting their own cash in. Good sign. Watching future Form 4s for insider activity will be key.
What about lockup agreements? Are the PI/PE investors stuck holding for a while?
This is a critical, nuanced point in the source. There is a restriction mentioned, but it's on the company, AST, issuing new shares, for 45 days after the S4 registration for the PI/PE shares goes effective.
Okay.
But this company lockup has many exceptions, big ones.
Like what?
Exceptions include issuing the PI/PE shares themselves, warrant shares, employee equity grants, shares for M&A, shares for Section 351 exchanges, shares in future offerings above certain prices. It's a long list.
So lots of ways more shares can come out even during that period. And what about the PI/PE investors themselves? Are they locked up?
That's the crucial point the source highlights. It found no mention of a specific lockup restricting the PI/PE investors from selling their shares once registered via the S4.
Ah, so the folks who bought at $1.35, seeing the stock maybe at $10, $12, they could potentially sell as soon as their shares are registered.
That's the implication drawn by the source. If there's no direct investor lockup, you could see significant selling pressure or overhang from those early investors taking profits. Combine that with all the exceptions to the company lockup. The potential for future dilution seems considerable. The S4 filing should provide clarity here.
Okay, let's brace ourselves. Chapter 7 in the outline, which the source calls Chapter 6, the risk assessment. Sounds like navigating a minefield.
It really does. The source is extensive here. First, market risks. Obvious one. Total dependence on the volatile Bitcoin price.
Number one risk, easily.
Absolutely. Exposed to daily crypto swings, broader crypto market sentiment, and macro factors like interest rates impacting risk appetite.
Then the risks from their actual business model.
The execution.
Yes, business model and execution risks, very high. Just the sheer complexity and novelty of juggling all these unproven alpha strategies at once.
The specific risks for each strategy. Yep.
Section 351, viability tax legal challenges. M&A execution buying troubled companies. Actually extracting cash is hard. Distressed asset recovery long, uncertain, illiquid. And derivative leverage, amplified losses. Counterparty model risk. Questioning that without additional risk claim again.
It sounds like they need flawless execution on multiple complex fronts simultaneously. That's incredibly difficult.
Exactly. The source questions the scalability of these niche strategies and the fundamental challenge of consistently outperforming Bitcoin, plus dependence on key personnel.
What about financial risks beyond market price?
Financial risks are substantial. Persistent dilution risk is huge. Initial merger, warrants, $1 shelf Section 351. It's ongoing. Valuation risk, highly speculative, no intrinsic value anchor, sentiment-driven, no margin of safety. Liquidity risk in their own investments like distressed claims, and cash burn risk if alpha fails or Bitcoin drops, forcing more dilution.
Regulatory and legal must be significant too. Crypto, complex structure, huge area. Regulatory and legal risks. Evolving crypto regulation is a major unknown. Risk to the Section 351 tax treatment. General Securities Law Compliance Scrutiny source notes the old ASST got a pre-merger investigation notice. And potential Investment Company Act classification risk, which would be a massive headache.
And lastly, the source mentioned U.S. tariffs. Any real impact there?
Likely minimal and indirect, the source concludes. No direct impact on AST. Maybe indirect via tariffs on Bitcoin mining gear affecting mining economics, which could theoretically ripple to Bitcoin price, but probably less than other factors. Broader macro fallout from trade wars affecting risk sentiment is possible, but not a primary risk for AST itself.
Okay. We've covered the massive transformation, the ambitious but incredibly complex strategies, the team, the shaky financials, the market hype and skepticism, the ownership concentration, and that mountain of risks. Let's bring it all together for the deep dive conclusion. Chapter 7 in the outline, the sources wrap up.
Right. The deep dive report concludes ASST is fundamentally reshaped. Gone is the small tech firm, replaced by this unique vehicle for Strive's ambitious Bitcoin Treasury strategy. The goal, not just hold Bitcoin, but beat it using these complex, novel methods. They have the capital, they have a team with relevant experience, though not directly tested in this specific model.
What the risks?
Overwhelming, the source stresses. Immense execution risk on unproven strategies. Massive market risk tied to Bitcoin, significant financial risks like dilution and valuation uncertainty, evolving regulatory challenges. The stock price reflects this highly speculative, volatile reality.
And how does the source explicitly evaluate this against core value investing principles, like Buffett's framework?
It's stark. The source concludes AST failed most, if not all, key principles. Not understandable, too complex, novel. Lacks a durable moat dependent on volatile BTC, unproven alpha. Questionable rational capital allocation, concentrated unproven bets. And crucially, no attractive price or margin of safety valuation, is speculative, sentiment-driven.
Even with experienced management and no initial debt.
Those points are noted as more mixed or initially positive, but completely overshadowed by the fundamental failures against core value tenets, according to the source's analysis.
So what's the source's final thesis, the stark conclusion we teased?
The thesis. AST is a unique, highly speculative vehicle. Success hinges on Bitcoin's price, flawless execution of novel strategies, and a stable regulatory environment. A trifecta of uncertainty, the stark conclusion. AST is appropriate only for highly risk-tolerant speculators with strong bullish conviction on Bitcoin and high confidence in Strive's execution ability in uncharted territory.
So definitely not for value investors.
Explicitly not suitable for value investors seeking understandable businesses with a margin of safety. That estimated May 2025 range of $7 and $15 just reflects the speculative nature and volatility, with the strong warning it can easily trade outside that on pure sentiment.
Wow. That's a massive amount to process. It completely reframes what this company is now, based on the source material. So here's a final thought for you, the listener, to ponder. Given this layered complexity, the dependence on Bitcoin's wild ride, and the extreme volatility, how can any investor truly perform meaningful due diligence here? And what does it mean for markets when valuations seem driven more by hype and financial engineering than by, old-fashioned business fundamentals? If you found this deep dive valuable, remember that as a Stock Analytics AI member at Euro 4.99 a month, you can give us a ticker and get prioritized for your own custom, deep dive tailored analysis based on your source material. Be sure to subscribe wherever you're listening so you don't miss future deep dives. And check out the Stock Analytics AI YouTube channel for more analysis. Just a reminder, this deep dive is based solely on the source material provided, specifically excerpts from the AST Deep Dive Research Report dated May 28, 2025, and its referenced news articles and filings.
It does not constitute financial advice, an endorsement of any viewpoint contained within the sources, or a recommendation to buy or sell any security. We are simply unpacking and analyzing the information presented in the sources using established analytical frameworks.